So this is again part 6 of my lecture on the accounts. So I have split these into small parts, minor parts, so that it is easier for you to go through. So here we shall see the difference between the contingent liabilities and the other liabilities. See, contingent liability means it is an obligation which may or may not arise. Whereas the other liability means it is the present obligation arising from the past events. So the contingent liability, again, its occurrence depends on the happening or non-happening of an uncertain future event. It may be a court decision. If it happens in our favor, it may not be a liability. Otherwise, it may be a liability for which we should be prepared with a provision. So that is the contingent liability. And other liability means it has already occurred. And no certainty of the outflow of resources in the case of contingent liability. Only if it goes against us, then only we will have to, incur the expenditure. Whereas in the other liability, there is a certainty because it has already occurred. And the contingent liability, it is not recognized in the financial statements. You don't quantify that. Whereas the other liability is recognized in financial statements with a financial value because it has already happened and you know how much you will have to shell down. And the contingent liability, on the other hand, so although it is not recognized in the financial statements, it is disclosed merely by way of a footnote to the balance sheet. Whereas other liability is disclosed on the liabilities side of the balance sheet with a value. For example, the bills are discounted but not yet matured. They are the examples of contingent liability. Bills are discounted but not yet matured. The arrears of dividend on, say, the cumulative preference shares. Other liabilities, the creditors for goods, you have to pay. The outstanding expenses, you have to pay. You have to pay for it. And similarly, what is the distinction between the provision and the contingent liability? So for the preparation of the balance sheet, these things or knowledge on these things are very much required. So a provision means it is a present liability of uncertain amount. You are making provision, but for an uncertain amount with some certainty. Whereas contingent liability means it is a possible obligation which may or may not result in the form of an obligation. And this provision means it meets the recognition criteria. Contingent liability fails to meet the recognition criteria. And provision is always recognized in the balance sheet. Whereas contingent liability, it is only disclosed as a note to the balance sheet. And the examples for the provisions, they are creditors for goods, outstanding expenses, the tax officer imposes the penalty for the violation of Tax Act. You will have to make the provisions. Whereas the contingent liability means, as I said earlier, the bills discounted but not yet matured, arrears of dividend on the preference share, cumulative preference shares. So the management files an appeal, say, if management feels that company has to pay the tax, where the tax officer has issued a notice, it recognizes a provision in the balance sheet. If management feels that the company has to pay the tax, if management feels the judgment will be in its favor, it discloses the liability as a contingent liability without recognizing a provision in the balance sheet. So the probable outflow and reliable estimates means you make a provision, and possible obligation means it's a contingent liability. The difference between the trade discount and the cash discount. See, the trade discount means the reduction granted by the supplier, by the contract, by the supplier from the list price. He has got a list price for different regions and he has allowed some discount, that is the trade discount. Whereas cash discount is discount further to that. It is from the invoice price again. That is on the trade discount already allowed. Again on the invoice value because of immediate payment or payment before certain date or payment in lump sum instead of installments. The company may also offer cash discount from the invoice price. And the trade discount is always allowed to promote the sales, to promote the business, whereas the cash discount is to encourage prompt and immediate payment. And this trade discount is allowed on the purchase of goods, whereas the cash discount is pertaining to focusing only on the immediate payment. And it is shown by way of the deduction in the invoice itself as far as the trade discount is concerned. So it does not come into your accounts at all in the invoice at all. But the cash discount, it is shown in the invoice. Cash discount, it is not shown in the invoice. So cash discount is already offered, so they will bill it. The invoice value is only after the cash discount, so they don't show it in the invoice. Whereas there they show it by deduction in the invoice. So invoice value, then the trade discount, then the value. And the trade discount account, it is not opened in the ledger, no trade discount head of account. Whereas the cash discount you have to open in the ledger because the value of the item is including this cash discount when you have to value that in your asset register. And the trade discount may vary with the quantity purchased, whereas cash discount it may vary only with the period within which the payment is made. So these are in general, what you will have to observe while preparing your statements of account. And of course, in the next part, I will only cover about the work to be completed during the month of March, any government organization. So with this, I am closing this part 6, I think part 6 of my lecture on the accounts. Thank you, friends.